You know that little voice in the back of your head? The one dreaming of a life where your income isn't just tied to those regular paychecks.
Yeah, that feeling.
Well, that's exactly the itch we're scratching today on the Deep Dive. Our goal, to really navigate the world of passive income opportunities looking ahead to 2025.
And it's all thanks to a great set of resources one of you shared. We've got a really interesting mix.
We do. What do we got?
Well, there's Investopedia. They've got a broad look at passive income, plus a deeper dive into dividend ETFs.
Okay.
Then Charles Schwab's perspective on those same ETFs. Dividend.com talking about high-yield stocks.
And something a bit different.
Yeah, and to get a feel for what people are actually saying, we're looking at some Reddit discussions about weekly dividend ETFs.
Interesting. So our mission here is basically to pull out the really useful stuff, right? The actionable insights, maybe some surprising facts.
Definitely. To help you, our listener, figure out how you might build some passive income streams in 2025.
We know you're busy, maybe you're planning something big, or just really curious. So we'll try to make sense of it without, drowning you in jargon.
Definitely. We'll keep the financial dictionary closed today.
And we know people listening have different levels of experience, right?
Yeah, absolutely. So whether you're already, familiar with investing or just starting out, we'll guide you through the important bits from these sources.
We're covering a lot of ground real estate, digital stuff, and those financial tools like dividend stocks and ETFs that you mentioned.
That's the plan.
Okay, let's unpack this first. What do we even mean when we say passive income for 2025, according to Investopedia?
Yeah, fundamentally, it's money earned with minimal ongoing time or effort, so separate from your main job.
Like rental income or stock dividends.
Exactly. Or maybe online courses you create once and sell repeatedly, things like that.
The key phrase seems to be minimal ongoing effort, right?
Yeah. Right, because often there's a chunk of work upfront, time, money, maybe both. But the goal is that it eventually runs mostly on its own. Little day-to-day input from you.
And it sounds like the outlook for 2025 is, pretty good. Margarita Chang, she's the CEO of Blue Ocean Global Wealth. Investopedia quotes her.
Yeah, she seems optimistic, pointing to things like online courses, ebooks, affiliate marketing, those kinds of areas.
Investopedia also helpfully breaks down income types, which can be a bit confusing.
It can. So you've got active income, that's your job, your salary, wages, direct effort.
Right.
Then portfolio income returns from investments, dividends, interest, capital gains.
Okay, and then passive income. This is where it gets tricky.
Well, yeah. Investopedia uses a broader definition in their main article, but the IRS has a stricter one.
What does the IRS say?
For them, it's mainly things like net rental income, income from businesses where you don't materially participate. We can touch on what that means later and some specific types of interest.
So passive income can mean slightly different things. That's important.
It really is. For today's discussion, exploring opportunities, we're mostly using Investopedia's wider sense. Things needing upfront work, but minimal later effort.
But we need to remember that IRS definition for tax time, right?
Absolutely critical. We'll circle back to that.
Okay. Now, Chang also gives some really solid advice. She stresses you've got to look at your own situation.
Yeah, like what are your cash flow needs right now? What's your time frame, short-term, long-term?
Or crucially, risk tolerance. How comfortable are you with potential ups and downs?
That's a core question for anyone listening, isn't it? What are your goals? What's your comfort zone with risk? There's no single right answer.
And she warns about those get-rich-quick things. Obvious maybe, but important.
Very. And she also mentions being realistic about upfront costs. Things like franchises or buying property, they need serious capital to start.
That pragmatic view is key. Chang says, be positive and optimistic while being pragmatic.
I like that. Aim high, but know what you're getting into.
All right, let's dive into some of the specific ideas Investopedia flagged for 2025. They grouped them by potential, starting with high potential. First up, real estate in the sharing economy.
Okay.
Premium space sharing. This isn't just like a normal storage unit.
No, it's more specialized. Storing things like fine wine, art, classic cars, maybe even high-end fashion. Things needing climate control or special security.
Right. People pay more for that.
Apparently so. Investopedia mentions Store at My House as an example platform, the potential income. Maybe $200 to $500 a month for those specialized spaces.
Advantages seem to be higher returns, maybe longer-term clients.
Yeah, but the flip side is you might need to invest in those features, climate control, better security, and insurance is a big one. Got to cover those valuables.
Makes sense.
Okay.
Okay, next, solar farm leasing. Sounds sunny.
Yeah, especially good in states with lots of fun, obviously. Basically, you lease your land to utility companies or solar developers.
And they build the panels. How's the income on that?
Can be pretty good. Maybe $500, $2,000 per acre per year for big projects. Often long leases, sometimes with inflation adjustments.
So, stable long-term income. Minimal effort once it's set up.
That's the idea. But you need a good chunk of land, and it needs to be suitable, flat, sunny. And consider how it affects property value overall.
Okay. Then there's just investing in real estate directly. Buying property to rent out or flip. The classic.
A classic for a reason. Rental income is the main goal, maybe $1,000 to $2,500 a month per property, highly dependent on location and size, of course.
Upsides are potential high returns, diversification.
Right. But downsides are significant too. High upfront costs, it's not liquid, can't sell it instantly. And management takes time, unless you pay someone.
And related to that is just renting out part of your own home, like Airbnb, or getting a long-term renter.
Yeah, very common. Short-term could bring in $100, $300 a day in tourist spots. Long-term gives that steady monthly check.
Drawbacks, vacancies, maintenance.
Exactly. And Investopedia rightly flags checking local laws. Huge variations there.
Okay, here's a niche one. Specialty vehicle storage. RVs, boats, classic cars.
Yeah, apparently demand is growing, partly due to HOA rules limiting where people can park these things.
And you can charge more for better features. Covered storage, climate control.
That's the angle. Income varies, maybe $100 to $500 monthly for an RV spot, potentially up to $800 for indoor climate-controlled boat storage.
Sounds like a growing market. Longer-term renters, maybe?
Could be, but likely higher insurance costs for you, and you might need to invest in those features. Security is probably a bigger deal too.
Okay. Similar idea to solar, but with wind. Wind farm leasing.
Right. If you have a lot of land in a windy area, energy companies might want to put turbines there.
How does that pay?
Can be quite high per turbine, maybe $4,000 to $8,000 per turbine annually, or based on megawatt capacity. Offers long-term income security.
But again, need lots of land. And you need a wind assessment first.
Definitely. Plus, think about visual impact, noise.
All right, something maybe more accessible. Renting out stuff you already own. Tools, equipment, maybe your car.
Yeah, pretty practical. Earn from idle assets. Income varies hugely, maybe $25 to $150 a day for some equipment.
Main advantage is using what you have. Downside.
Wear and tear, definitely. Liability is a big one. What if someone gets hurt? You need solid rental agreement.
Good point. Last one in this high potential real estate group. REITs, real estate investment trusts.
Right. So instead of buying a building, you buy shares in a company that owns and manages a portfolio of properties, usually commercial ones.
So you get real estate exposure without being a landlord.
Exactly. And they typically pay out dividends. Investopedia mentions yields from 1% up to 10% or more annually.
More hands-off.
But risks.
Performance can swing with interest rates and the economy, and there are management fees you pay as part of the fund.
Okay, let's switch to the other high potential category, investment and finance. First, bonds and bond funds.
Often seen as lower risk than stocks, more predictable income. Yields typically maybe 2% to 5% for individual bonds, 2% to 6% for funds, according to Investopedia.
Stability is the draw, but lower potential returns than stocks. Generally, yes. And they're still subject to interest rate risk if rates rise. Existing bond prices tend to fall. And credit risk, the issuer might default. Diversification helps.
Okay. Then, dividend-paying stocks. Our listener was keen on this, so we'll circle back, but the overview.
Investopedia suggests potential annual yields maybe 2% to 7%. The big appeal is that regular income via dividends, plus the stock price might go up over time.
But stocks are volatile, right?
Yeah.
And dividends aren't guaranteed.
Exactly. Companies can cut them. So research is key. Look for stable companies with a history of paying. And reinvesting those dividends, that really boosts long-term growth, compounding power.
Okay. Peer-to-peer lending. Platforms like Lending Club.
Where you lend directly to people or businesses. Potential returns can be higher than savings accounts, maybe 4% to 12% annually per Investopedia.
Higher returns, but higher risk.
Definitely. The borrower might default, and your money's tied up for the loan term, so it's not liquid. You really need to assess the risk and the platform itself.
Got it. Last one in this high potential finance group, index funds, like S&P 500 trackers.
Yeah, they give you broad market exposure, lots of companies at once, potential for dividends and capital gains. Returns vary with the market, obviously.
Big advantages, low cost usually, Simple way to invest broadly.
True, but you don't control the specific stocks, and you're tied to market ups and downs. Low fees and a long-term view are usually the way to go here.
Okay, moving down a notch to medium passive income potential. Digital products and content. First, create an online course.
If you got expertise, platforms like Udemy or Teachable make this possible. Income varies hugely depends on topic, quality, marketing.
Scalable though. Create once, sell many times.
That's the beauty. But it takes serious time up front to create it, and some topics are really crowded. Plus, you need some tech comfort.
Next, automated dropshipping. Selling stuff online without holding inventory.
Yeah, you're the middleman. Startup costs can be low, fulfillment is handled elsewhere.
But margins are probably lower.
Tend to be, yes. And you really depend on your suppliers for quality and shipping. Plus, it's super competitive.
Okay, YouTube content creation. The classic digital path.
Ad revenue, sponsorships. Potential there. Investopedia mentions maybe $1 to $5 per 1,000 views, but it varies a lot.
Global audience, different income streams, but hard work.
Huge time commitment to build a channel. Algorithm changes can hurt. Needs regular, good quality content and engaging with your audience. Very competitive.
Creating an app. Sounds more technical.
It is. Or you hire developers. Income potential is all over the place. Could be huge, could be nothing.
High demand potential, maybe recurring revenue, but costs.
High development costs, fierce competition in the app stores, needs constant updates and marketing.
In a new order twist, AI-backed tools and apps.
Like AI tutors or language tools, revenue via subscriptions or in-app buys, distribution via app stores is easier, AI allows personalization.
Competition again.
Intense, and the tech changes incredibly fast. Plus, it really depends on the quality of the data used to train the AI.
Right, shifting to low-medium potential, creative and licensing. Designing custom products, t-shirts, mugs.
Using print on demand like Redbubble, Etsy, Shopify. You design, they print and ship when someone buys.
So no inventory hassle.
Yeah.
Scalable.
Yeah.
Creative outlet.
Yep. But income per item is often small, and the market is very saturated. Marketing is crucial. Finding a niche helps.
Affiliate marketing. Promoting other people's stuff for a commission.
Low startup cost, lots of flexibility. You promote via links on a blog, social media.
But income depends entirely on driving sales, right?
Totally. And competition is fierce. You depend on the affiliate programs staying good. Need solid marketing, maybe SEO skills.
Selling stock photos for photographers.
Upload to sites like Shutterstock, Adobe Stock. Earn royalties per download.
Low barrier if you have the gear and skill.
Yeah.
Artistic.
But income per sale can be tiny cents sometimes. Huge competition. Need high quality, in-demand shots, good keywords.
Licensing your music for composers.
Get paid when your music is used in videos, ads, etc. Use platforms like Audio Jungle or license directly.
Variable potential. True passive income once it's out there. Exposure.
But income is unpredictable. Competitive market, need equality, varied catalog, good metadata so people can find it.
And advertising on your car. Those wraps.
Yeah, services like Rapify, Carvertise, they pay you monthly to drive around with ads on your car.
Very little effort, seems like.
Pretty much, but you don't choose the ads. Small risk of paint damage, maybe? Stick to reputable companies.
Okay, we've covered a huge range of ideas there. Now let's really focus on what our listener highlighted. Dividend ETFs and stocks.
Right, drawing from Charles Schwab, Investopedia, and Dividend.com. So dividend ETFs, what are they?
Both Schwab and Investopedia say they're funds holding a basket of dividend-paying stocks.
Key benefit right there. Diversification. You're not banking on just one company's dividend.
Plus professional management, which helps if you're newer to this. And the main goal, regular income from those combined dividends.
Investopedia gives good examples. SDY, the SPDR S&P Dividend ETF, focuses on dividend aristocrats.
Those are companies that have raised dividends for, what, 20 plus years straight?
At least 20 for SDY, yeah. Show stability, commitment to shareholders.
Strong signal. What else?
VIG Vanguard Dividend Appreciation tracks companies with 10 plus years of dividend growth. VYM Vanguard High Dividend Yield focuses on stocks with high current yields.
And HTV iShares Core High Dividend and VNQ Vanguard Real Estate ETF for REIT dividends.
Lots of options depending on your specific goal, growth, high yield, quality, focus.
Now, a really crucial point from Investopedia about taxes.
Yes, this is important. Even if you reinvest the dividends automatically.
You still generally owe tax on them in the year you receive them, just like individual stock dividends.
Right. Reinvesting doesn't defer the tax liability in a standard brokerage account. Good to know.
Okay, shifting to individual dividend stocks, Dividend.com makes the case for high-yield stocks for income and maybe long-term growth, usually larger established companies.
But they also throw up a big warning sign, right, about yields that seem too good.
Yeah, exactly. A super high yield might mean the company's in trouble or the payout isn't sustainable. Could be a red flag.
So you have to look deeper than just the yield number. Dividend.com stresses screening based on other metrics.
Like what?
Market cap, avoid tiny, volatile companies. Earnings reports, future guidance. PE ratio, price to earnings, to see if it's overvalued.
Payout ratio. What percentage of earnings are paid out? Is it sustainable?
Crucial. Also, dividend history, are they growing it? And broader industry trends, is the sector healthy?
These factors give a much better picture of the company's health and whether that dividend is reliable.
Absolutely. Consistency is often more valuable than just a high number right now.
Dividend.com gave a list, just as an example, right? Around 20 stocks yielding about 4% back in May 2025.
Yeah, across different sectors. Financials like Lions Bancorp, HCB Financial, real estate like Killam Apartment Right, utilities like Evergy, even international ones like Aviva.
Just gives a flavor of the types of companies. But obviously,
any list is just a snapshot. You absolutely must do your own research on any individual stock before investing, always.
Absolutely. Okay, now for something newer and maybe controversial, weekly dividend ETFs. From Reddit in that Weekly Dividend Stocks article.
Yeah, the main example is WKLY, the SoFi Weekly Dividend ETF. The appeal is obvious.
Yeah.
Getting paid every week.
Frequent cash flow. What did the article say were the pros and cons?
Pros. That weekly income, diversified portfolio, low expense ratio seemed okay. Cons. Maybe limited capital appreciation potential. Yield might be lower than some other high-yield funds that pay less often. Maybe not great for short-term trading.
And what did the Reddit folks think? Sounds like skepticism?
A lot of it, yeah. User Dad1 basically said payment frequency should be way down your list of priorities compared to quality and growth potential.
Makes intuitive sense.
Yeah.
Don't let the tail wag the dog.
Right, focusing only on yield or frequency might mean you overlook fundamental weaknesses.
Someone called them microwavable dividends.
Ha, yeah, stock profit girl. Captures that impatience, wanting faster payouts than monthly or quarterly.
But others, like Dangerous Purpose 5661, Pleasantly Clueless 69, double down payment frequency, is a poor investment criterion. It shouldn't be the main driver.
Exactly. Total return is what matters, dividends plus price changes. Some compared it to picking a job just based on weekly versus bi-weekly pay, ignoring the actual job quality.
Were there other concerns on Reddit? Like about the fund value itself?
Yes, NAV depreciation, net asset value. Users QuirkyAd6271 and anyone worried that some of these high-yield funds, including weekly ones, might just be paying you back your own capital while the share price steadily drops.
Ouch. So the total return could actually be negative even with dividends.
Potentially, yes. That's why users agitated whereas 7463 and Wereborg under 10 stressed comparing total returns. If the price decline eats up the dividends, you're losing money overall.
And another point, these are mostly new, right?
Very new, relatively speaking. Musicookie and Apollomac pointed out many haven't been tested in a real bear market or recession. We don't know how they'll hold up under pressure.
That lack of track record is a risk factor in itself.
It is. Past performance isn't predictive, but seeing how something weathered storms gives some confidence.
What about taxes with weekly payouts?
Nighthawk 35449 suggested holding them in a tax-advantaged account like a Roth IRA might be smarter to avoid triggering small taxable events every single week in a regular account.
That's a practical consideration. More paperwork, potentially slightly different tax outcome.
And Raleigh Bond made an interesting point. It costs the ETF provider something to make those weekly payments. That cost eventually gets passed to investors somehow.
Maybe through fees or slightly lower performance. It's not free.
Yeah, unlikely to be free, no.
Did Reddit mention alternatives for income? Like covered call ETFs?
Briefly, yeah. Some of those pay weekly or monthly. Users Bonham Gillicuddy and Abnormal Investing suggested they can generate income, especially in flat or down markets, from selling call options. You could reinvest that income.
But they have downsides too, right?
Yeah, No Pants 21 pointed out they often underperform in strong bull markets because the calls cap the upside. And NAV depreciation can still be a concern there too.
And one final Reddit thought from DSCN 034. if you're investing for the long term, like retirement, and just reinvesting dividends anyway.
Does the frequency really matter that much? Weekly, monthly, quarterly? If you're not spending it, maybe total return over the long haul is the only thing to focus on.
A fundamental question about priorities. If growth is the goal, total return likely trumps payout timing.
It really gets to the heart of your investment strategy.
Okay, nearly there. Let's quickly revisit the IRS definition of passive income from Investopedia again, just to be clear for tax purposes.
Right. Remember, their definition is often narrower than common usage.
What do they exclude?
Generally, interest, dividends, annuities, most royalties. They often call that portfolio income.
Okay, what do they include?
Net rental income is a big one. Income from businesses where you don't materially participate.
And there are specific rules for that, like hours spent.
Yeah, the 500-hour rule, the substantially all participation rule, the 100-hour rule in some cases, it gets technical, and some specific self-charged interest.
In Investopedia, you mentioned you can use losses from one passive activity to offset gains from another.
Generally, yes. That's a key tax aspect of IRS-defined passive activities. But again, most investment income, like dividends and capital gains, usually not passive income for the IRS.
Good clarification. Okay, let's wrap this up. Final thoughts. It seems Margarita Cheng was right around. Lots of passive income prospects for 2025.
But, and it's a big but, you really need to understand the upfront effort and the risks involved with each path.
And the best strategy? It's totally personal. Depends on your cash flow needs, your time horizon, your risk comfort level.
No one-size-fits-all answer. And specifically with dividend investing, looking beyond just the yield number is crucial. Check the company's health, the dividend sustainability. High yield can be a trap.
And those weekly dividend ETFs. Appealing frequency, maybe psychologically.
But maybe not the best for long-term total return or tax efficiency, based on those Reddit discussions. Frequency isn't everything.
So the bottom line seems to be, do your homework, research thoroughly, think about diversifying across different types of passive income.
And make sure whatever you choose actually aligns with your financial goals. Plus, understand those IRS definitions for tax time.
So, summing up, 2025 offers a huge range of passive income options. Real estate, digital stuff, financial instruments.
Each with its own potential upsides, but also its own risks and things to consider. Being informed means knowing both sides.
The rewards and the risks, plus the tax stuff.
Exactly. So maybe a final thought for you, the listener, to chew on.
Yeah.
Given this incredible variety of options we've talked about, and even the different ways people define passive income, what criteria will you prioritize when you start building your own income-generating portfolio?
Something to think about. Thanks so much for sharing those sources with us, and thanks everyone for joining this deep dive. If you've got sources you want us to tackle next time, definitely send them our way.